Hello, guys. This is me, Joseph AGK Orji, uh, keeping you company again today. Our main topic today will be the profitability ratios, and then we look at those ratios, the main types of profitability ratios, and then do some example on how to use it to evaluate a company. Now, let us begin with this, and then I'm going to start with sharing my screen and we will go from there. So, like I said, we'll cover a lot of grounds on the profitability ratios. So, we call them profitability ratios because we use them to figure out, you know, how or whether a firm is performing well with respect to generating profit. So, this means that when we want to find out or assess a company to or the company's ability to earn profit from their sales and their operations, then that's when we use the profitability ratios. There are three main types. The first one is the net profit margin. Net profit margin. The second one is the return on total assets. I'll call it just return on assets. Then the third one is return on equity. Some people will add gross profit margin to the list, but these are the major ones I prefer to use, and I'm going to show you how to calculate them one by one. So let us begin. We'll start with the net profit margin. How to calculate the net profit margin. So first of all, what is the net profit margin ratio? What is it used for? Generally, as a profitability ratio, we know that we use it to check if the company is making money or generating sales, profit from their sales. When we want to check or assess a company's ability to generate earnings, when I say earnings, I mean profits. So when we want to assess a company's ability to generate earnings or profits after all expenses and taxes have been calculated, we use the net profit margin. And the formula for this ratio is net income divided by net sales. Because this one we're using the profitability, the net profit margin, not the gross profit margin. Now, when we say net sales come from revenue come from sales, so we can also use sales revenue for as a proxy for net sales. Then is a percentage multiplied by 100. Now, if you're using Excel, once you divide it, you can convert it to percent by using the Excel function that converts your answers to a percentage. What does this ratio tell us about a company? Well, I've already explained it. We use it to measure the overall success of a business with respect to generating earnings or profit for their sales. We also use it to, let me put it this way. Generally, a net profit margin of 10% or more is considered excellent. But that depends on the industry anyway, or the type of company we use. So a net profit margin that's less than 10% is not that excellent. Now, it depends on the analyst. Some analysts might find net profit margin of 5% as good enough to make a decision to invest in that company. So let us see how to calculate net profit margin. And like I explained in my previous lectures, the information we use for all this estimation comes from the company's financial statements. And then I'm going to show you some of the financial statement for Walmart, and we can now calculate it. I did some examples here. I will go to the financial statement for Walmart. I have them already in Excel. So I'm going to put it right here to that place so you can see it. This is the Walmart income statement for Walmart. Let me make sure you are seeing this. Yeah, okay, you are seeing it. This is the income statement. These numbers here, they are like this because of the space. So I'm going to make the space a little bit bigger so you can accommodate, open up. You can see the numbers. You can see they are like that because of the space. So I'm going to open this, make the space bigger. Yeah. Okay. Now, we're ready. We're going to calculate the profitability ratio, the net profit margin for Walmart for this number of years, 2021, 2020, and 2019, because we have the data here. So for the Walmart, those months we have net income is 13. Some analysts might use this net income and to be able to control in share. No, I don't know, not this one. This is one we're going to use. So I'm going to copy it and then paste it here so that we can have our numbers here. Remember, when you're pasting, make sure you choose one that shows numbers here. See, this one shows numbers. Okay. The next one is net sales. Net sales, which is right here, net sales. In some books, they report them as net as revenue, you know, because revenue comes from sales. So we have it here for Walmart. Again, paste it. Good. Now we can now calculate the net profit margin for Walmart. Let me make sure you're seeing this. Okay, good, you're seeing it. Net profit margin for Walmart, you have equals, again, the formula is, let me take you back to the PowerPoint so you can see the formula again. So I'm gonna move that place to the PowerPoint. Formula is net income divided by net sales, okay? Now, back to our Excel for the actual calculations. We have equals net income divided by net sales. See, I'm sure you must have observed, and I have already explained it before. Each time you want to start doing any work on Excel, put the equal sign first, so that Excel will be in that particular cell will be in a ready mode for calculations. So, net income, excuse me, net income divided by net sales. Do this. And then you can copy the formula to the other years so that it will do the calculation for the other years. And usually I have it in 2 decimal places. So I'm gonna format this and make it number. Well, it's a percent. So I'm gonna make it a percentage. So you choose percentage here. And then that gives us the net profit margin. Now you can see that for those years that I checked, Walmart does not cross the 10% mark. How do you interpret it? For 2021, Walmart generated 2.47% profit from their trading operations. In 2020, they did generate 22.92% of profit from their trading operations. Well, Walmart actually is not really making big profit margin from their sales. I know that some of they make sales, no doubt, but their margin is so small. That's why the goods there are cheap, because they want to use price as the key to attract customers. So for them to make profit, they have to sell large volume. Now, Let me take you to the PowerPoint so you can see exactly how I interpreted it in for this year so far. This year have not finished yet, but we haven't said in Walmart converted 2.47% of all the sales into profit in year 2021. And in 2020, it converted 2.92% of all the sales into profit. Now, prior to that, those years, Walmart converted in 2019, it converted 1.41% of all sales into profit. So it actually showed a growing trend. Let's see, hope that it continues that way. At this point, we might like to calculate the net profit margin for different companies. And because you're not going to put all your money in one basket, you can calculate it for Walmart targets and then find other companies that are not in the same industry as Walmart and Target. So to do that, I'm going to take you to Yahoo Finance. So I'm going to open up a page, a website. Let me see. Let me open the website first. I'll take you there. Okay, I've opened the website. So I'm going to share that website. Okay. It's not showing here. Let me see. Okay, let me see if I can see the website. If I here. So how come it's not showing? Okay. I'll open it and then let me put this together first. Okay, now I can try it again. Google. I want to share it. So I'm going to type finance. Okay, 1 minute. Okay, good. Finance.yahoo.com. Opened for us. And I'm going to open the first company now we are about to get is Walmart, of course. We have Walmart information there already. Let me put it in. I'm going to put this in. This is coming in between us. Okay, I have it right here. So Walmart for 2021, net income is 13,706. Net sales is 555,233. And target. So let's look at target. That part we can get from the Yahoo Finance, assuming that they have 2021 data yet. If they don't have it, we use what they have in their record. So target is target. You can see Target Corporation right here. And click on it, and you bring it up. Now, once it brings it up, you can look at their financial statements, which we will get by clicking on the financials. So this is the financials right here. And they say income statement right there. So you can see my book, the income statement here. We need to find the sales, net income, and net sales. So for Target, net income, we find it here, right here. I believe they have it. Okay. Net income. Net income from continue up. Okay. Normalize net income. Let us just use net income from continue. Okay. Let me see the best one to use. Okay. Net income. See, net interest income. No, we can't use that one. Net income from continuing and disposable. Okay. Probably can use that one. Let me see which one is better for us to use. Because here you have to be the same as we have. And this should be the net income right here. So you can see net income. Here we have it as 6181. Okay, 6181000. Now, this is for 2020. What year is this? Yep, 2021. So net income is right here. Right here. Sorry, my mistake. I wrote the wrong thing because this is the 2021 and this is the what? Oh, this is quarterly. Yeah, because this is the first quarter we have. So we have it here as for 368 000. Okay. Now we have next thing we need is the net sales for Walmart. But yes, the net sales, that means total revenue. Because revenue comes from the sales. So we use the net as the total revenue as net sales. Have it 93561,000. Now that's for target. The other company we are using is the Facebook, but let us put the target information for target here. Net income is 4368 000. And we have the net sales 1993 561. Now let's look at Facebook, a company that is very not in the ATM industry. And like I said, if you're an investor, you don't want to spread your wealth. Don't put them only in one industry. If you put them in one industry, if that industry goes down, all your money will be gone. But if you spread it properly, there's no way all of them will go down at the same time, except if there's a recession. If there's a recession, then that can happen. Even in a recession, there are still some companies that might be doing well, even though we are in a recession. Okay. Now, for example, during the COVID-19, we have a small recession caused by COVID-19 for 1 year. Now, most companies are not doing well during that time, but companies like Zoom and other companies that use video conferencing, like there's one Skype, Zoom, and they were doing well. They were actually booming, so that can happen. So that's why if you put all your money in those companies that are down, then you'll be in life in something that is similar to what I call financial life support. Okay. Now this is like this because of the space, so I'm gonna make the space a little bit bigger. Okay. Okay, good. Now, next thing we need to put is for Facebook. Look at for Facebook. I'll take you to Yahoo Finance again. Yahoo Finance, Facebook, the symbol is FB, actually, FB. I give Facebook Incorporated. So I have Facebook. For Facebook, we have net income and then net sales. So net income for Facebook, as you can see, we go to the financials, and then from there we can get our net income. It has 2020 data. That's the latest they have. Let me see why. Okay, I think they have the current. They have 2021 income. When I use the quarterly statement. So for Facebook, 1 minute, let me double check this, make sure everything is correct. Good. Because like I said, I'm using the actual financial statement of a real company. So net income for Facebook, you can see right here for 2021 so far. Net income right here. See, net income from continuous operations. See, 9,479,000. Okay, and then the net sales, the sales revenue for 2021. I can see the total revenue, the sales. So those revenue come from sales. So it's a good proxy for net sales, which is 26,171,000. Okay. So we have that information. Then we go and put it in Excel, in our Excel. Okay. So for Facebook, we have our net income as 94,79. I think I missed something there. Let me double check it. For Facebook, net income. Okay, we have net income available. See, 9,479,9,479. Okay, I got it. It's correct. 9,479,000. Okay, 79,000. Now, their net sales will be 26,171. Now, last company we are putting here, you know, most analysts will put like 10 different companies and then check the ratios and then make their pick on there. So next one we have is the company that we call McDonald's. McDonald's, we all know about McDonald's, very popular company worldwide. The symbol is MCD, I believe. MCD, you can see the McDonald's Corporation right here showing up. So McDonald's. So those of you who want to, you know, evaluate stocks, you can see how it is done. Very easy. You can figure out. It's not like rocket science. So this is McDonald's. So we look at the financials so I can bring up the income statement. We are looking for net income and net sales. So in this case, net income, let's look at the quarterly statement. You can tell us the net income. So this net income is 1,537,200. Then net sales. For net sales, we use the self revenue. Okay, total revenue. We have 5,124,600. So we have, I'll take it to the Excel so we can put this number in. McDonald's, and make sure you're seeing this. Okay. McDonald's is 1,537,200 for the net sales, and for net income, sorry, for net sales also we use revenue, which is 512. You have 46,000. Okay, well, I will check. Okay, good. Now with this, we can find the net profit margin for these companies. So again, it is net income equal net income divided by net sales. Okay, then press the enter key and then copy all this all the way down. So you can see right there, I can make them percent. Right click, format cells, and make them percentages. Okay, so you can see among all these companies, you can see which one that generated sales, more sales, from their activities. So now we see which of them make more money, more profit. Sorry, I think I came here by mistake, so I'm going to put it in. Now, in 2021 so far, McDonald's converted 3% of its sales into profit. Facebook converted 36.22% of its sales into profit. Target converted 4.67% sales into profit. And Walmart converted 2.47% sales to profit. Now you be the judge which company is better here and which is better to put your money in. So like I said, this is where the investor, we the analysts, we analyze, we give you the results. You the investor come down, decide where to put your money. So this is how we calculate the first profitability ratio, the profit margin. Let us now proceed to the second type of profitability ratios, which would be the return on assets. Return on assets. Okay. Now, return on assets serves as the indicator of how profitable the company is. Many analysts use this. So they use it to show how profitable the company will be relative to its assets or resources that the company owns or controls, And the formula is very simple: net income divided by total assets. So now let's just do it for McDonald's. So we can to do that, we go back to the financial statements of the company. Sorry, let's do it for Walmart, not McDonald's. We'll go back to the financial statement of the company. From this company, Walmart, we have that the net income for various years. Net income is right here for this. Okay. Okay, let's put this here, and then this is net income. Again, paste this. Remember to paste the numbers. Then we can now go to the balance sheet, because that's the place we will find the total assets. So for the balance sheet, total asset for Walmart, this is Walmart balance sheet, I believe. Okay, this is not Walmart. Okay, right here, this is Walmart balance sheet. See, Walmart Incorporated. Total assets. We have total assets only for 2 years. Have it for 2021 and 2020. Okay, it doesn't matter. We use what we have. I copied it, and then I pasted it. I'll have to paste it in the section that have the income statement. Okay. So I'm gonna paste it here. Okay. So we're gonna remove this one because we don't have the 2019 data for that. So now the return on asset equals to the net income divided by total assets. Okay. So this is a percentage. So I'm gonna, after calculation, copy it to the next one, then convert it to a number, even if a number. Math cells, make it number or percent, if you like. Make it percentage. Actually, it's a percentage. Now, you mean that, let me highlight it first and take you to where you will see it. It clearly explains in the PowerPoint. You can see it for the 2 years, 6.43% and 5.43%. So let me show you how this can be interpreted. Like I said, many analysts use it, to check how profitable a company is related to the assets they own. Now, in 2021, it is 5.43%. which means that for every $1 that Walmart invested in that year in assets, that one, like every $1 they invested in assets that year generated 5.43 cents of net income. Not too much, but again, Walmart doesn't have a high margin. Now in 2020, it was 6.43%, which means that every dollar that Walmart invested in assets that year generated 6.43 cents of net income. So that's how it's interpreted. I hope you are getting the picture now. Okay. Now, next one, we're going to looking at the return on equity. The return on equity. How do we calculate return on equity? Usually, the formula we use is net income divided by the shareholders' equity. So, but what is the return on equity anyway? Well, we use the return on equity ratio to measure a company's ability to earn a return on its equity. The equity is the owners, what the owners invested in the company, or kind of the investment they made. So, how much is it returning to you? I mean, it's return on equity. Now, utility companies like the Baltimore Gas and Electric Company usually have many assets, many high-tech, how do I put it? Heavy equipment assets and also debt. So usually their return on equity are relatively small, So they can have a return on equity of 10% or even less because of that. But company like Walmart may have a return on equity as high as 18% or more because of the fact that they don't have they do not invest in heavy equipment that usually buy using loans, So the way we use it depends on the industry. So what is high in for one industry may be low for another industry. That's what I guess that's what I'm trying to say here. Now, return on equity. The formula is net income divided by shareholders' equity. Let us do it for Walmart. And then I'm going to get it from here with Walmart. Return on equity, net income. Let's get the net income for Walmart is right here. I'm going to copy it. And then, paste it here. Okay, numbers. Then let's say shareholders equity. That one we can get from the balance sheet. So I'm going to take you to the balance sheet for Walmart. Shareholders equity. See, this is Walmart balance sheet right here. Walmart Incorporated. Shareholders equity is right here. Total Walmart shareholders equities. Total Walmart shareholders equities right here. I'm going to copy it and go to the income statement section and paste it there. Oh, my mistake. I paste the numbers. Make sure it's paste. Oh, I have to repeat this. Okay, good, no problem. Let me take you back. I pasted it the wrong way. Copy it. Take you right there and paste the numbers, the actual numbers. So it's right there. So return on equity equals, again, net income divided by shareholders equity. And then copy it. Now we don't have information for 2019, so I'm gonna remove it. So now let me right click and make it a percent. They're all percentages. So percentage or just a number. Make it highlighted so you can see them clearly. You can see right here. So what does this mean for us, Walmart? Okay. Now, I have it here as well. So In 2021, it has a return on equity of 16.94%, which you can see very clearly in the Excel. 2021, 16.94%. For 2020, 20.36%. So it actually declined, but it's still, not a negative value, which is a good news in a way. So how do we interpret it? There are two ways you can interpret it. You can compare it to the industry. I can say that Walmart, the return of an equity of 16.94% means that for every dollar that Walmart that the shareholders invested returned $16.93 in 2021. Now, for the 2020, hold on, let me see. For 2020, you can see that for every dollar that Walmart shareholders invested, returned to about $20.36, which is good. So it went down. This can cause the shareholders to get concerned a little bit because it declined. So when they publish this financial statement, you see the stock price go down a little bit. Then after a while, like maybe a week, two, by the time the analysts must have dig through their book and say, oh, well, it's a small decline. This can happen. Then the stock price start inching up again. So, my ladies and gentlemen, this is where we end the lecture for this morning. I hope you enjoyed it. Thank you for listening. And again, my name is Joseph Ejikoji, and I will see you in my next lecture. You'll have a good